Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Fine. What happened to your palm trees, Andrew?
Well, now that I'm taping this in the office, so I'll have to get the palm trees back or figure out. More importantly, obviously I have macro hive in my palm, my hand here.
Of course.
Um, okay, let's let's start as we always like to do, kind of recap the past week and kind of big takeaways that you have, any market reactions, anything that stood out or surprised you.
So in terms of Fed, there was a speech by Waller that surprised me. He basically said the combination of fast growth and slowing inflation is inconsistent. Something has to give, and if inflation doesn't give, we're going to have to hike more, even with yields where they are. So that's new. That's hawkish. And I suspect that's probably quite close to what Chair Powell is going to tell us today. And it makes sense, by the way. That has been my view, as you know, for a long time.
Okay. Market reactions. Are you?
Zero.
I don't.
No
Yeah.
market reaction.
Um, you know, particularly you and Mustafa have been really out in front, um, for this view for such a long time. Uh, are you surprised by the speed of especially the sell-off in the back end?
Oh, it's one of those things. Okay, when you have something like a regime change, typically you don't get a trigger. You have people who watch the price action, watch the news, and then it's a little bit like a bank run. There is some randomness to it. Then it all happens, and it builds momentum. We had sell-off around the end of QE1, QE2. We had a big sell-off in 2018 when it looked like inflation, PCE, was going to stay around 2% in a sustainable manner, which I think was the first hint of a possible regime change. And in those cases, there was no specific trigger. It's just a little bit like what is in the cartoon, the coyote that runs above the empty space and suddenly realize that there is nothing under it,
Right,
and then it
right.
falls. So I think
Yeah,
it's, what is it called? Wily
Wile E.
Coyote?
Coyote. Yeah,
Yeah,
Wile
it's one
E.
of those
Coyote.
moments.
Yeah.
Yeah.
And I know often, a lot of the market likes to fit a narrative around price action. It's not always the other way around. Let me ask you one question. But there's nothing. This was like I saw something on Twitter or somebody was saying when you have so much debt outstanding and now you're paying at such, and the government is paying such high interest into the market. And now a lot of this is, as Bilal's work is, much less going to central banks and much more going to households, and pension funds. Well, let's concentrate on households who are getting that. And in many cases, we already, we agree that they're not nearly exposed to the effects of duration as they have in other periods. So they've locked in long-term rates. In fact, they may have extra cash and they're putting it to work on these higher yields. Um, is there a scenario that obviously there's other stuff like the Fed and also the central banks, which are that are, pulling liquidity out of the system. But is there a case that you can say that these high yields and high levels of debt are actually adding to liquidity into the system?
So
Like,
what
is
you're
that maybe
saying.
an explanation why growth has not come off?
So I don't think that's the explanation, but for sure, somebody's liability is somebody else's asset. So when you have a transfer between the two, the net impact on the economy depends on who has the highest propensity to consume, and it's typically the people who are in debt.
Right.
So in that sense, higher interest rates are negative for demand because you take purchasing power from people who tend to spend more to give it to people who save more. But I don't think it's that important at the
Right.
moment. The thing that, and by the way, this is the topic of my weekly, the impact, the long-term impact of these high yields. I think what people are missing is that we have high yields because we have high nominal growth. And
Yeah.
so it means higher income for both household and corporates. And so it means that the negative impact of those high interest rates on growth is going to be limited by the associated higher growth in income. So I'm afraid Governor Waller it's likely to be proven right on
Proven
this
right.
one.
Yeah. And I guess for the propensity for people to spend, as you say, the kind of the middle to lower income, then it really just comes down to what is the relationship by how fast their wages are going in relation to inflation or their exposure to the different parts of inflation. Um, and if that's imbalanced or even wages are outperforming, then the economy should stay fairly strong.
Yeah, I mean, actually, what's going on is that, and I think that's one of the reasons why Biden is lagging in the poll, is that real wages have not kept up with inflation. If you
Right.
measure them with PC, they are barely at the same level as end 2019. If you measure them with the CPI, they are 5 to 10% lower. But what has happened is that the quantity of people who are working has gone up because the administration has opened legal immigration, which I think is one of the reasons it's doing so badly in the polls.
Right.
So big
Okay.
increase in consumption, but individual consumers are not doing that
Not
well.
as happy. Right. Okay. Um, that's great stuff. Okay. And now all important views on the week coming up.
So end of month data, we will get the PC. The very interesting part of the release will be where we have scope for surprise. Core, super core services. I mean, we already know that OER is going to be accelerating. It's the same data as in the CPI. And there I suspect we'll see an acceleration because in fact, if you looked at the CPI release, median price CPI, which at a time of high volatility is more reliable than core CPI, you saw a turn and you saw a correlation between energy CPI and median price CPI. And I suspect we're going to see the same with core PC. But I'd almost say this is not the most important release. We're finally getting the much talked about GDP. The Atlanta Fed
The
is at
5% GDP.
5.4%. They're probably wrong, but the consensus is at 4%. And I think 1.5% of that could be a huge inventory swing. So a combination of a net export and inventory accumulation, which by the way shows us that supply chain issues have not been resolved because this sort of inventory swing did not happen before the pandemic because global supply was much more predictable. So people didn't feel the need to adjust. So the fact that we're still having those swings shows that despite all the sophisticated indices of supply constraint, that is out there and showing that supply is actually stronger than before the pandemic, they're wrong. I mean, we're still having issues. And in fact, anecdotally, you still get a lot of evidence that businesses are having difficulties sourcing input. So, but even without this huge inventory swing, if you look at the component of the Atlanta Fed nowcast, consumption is strong, residential real estate is strong. In fact, it's going to be the first positive contribution of residential real estate to growth since 2021. You also have non-residential investment, which is like going gangbusters because we have these crazy government policies, the so-called Inflation Reduction Act, which is doing everything but reducing inflation, because it's giving enormous amounts of subsidies for private investors to build foundries and, you know, to invest in our green future. And, you know, whether it pays or not remains to be seen, but for sure it's pumping up demand in the short term. And then we had a little bit of a cycle in consumption, where in Q1 there was an enormous increase in car purchases. And so that depressed consumption of durable in Q2. And now we are normalizing, and it's amazing. You look at durables consumption, it's going gangbusters, despite the huge increase we had during the pandemic, which just shows, you know, that we're, in my view, we're still digesting the hangover from the extreme pandemic stimulus. So, you know, Q4 is probably going to be not as strong as Q3, but definitely still above trend and
Yeah.
not helping the Fed.
Yeah.
Other than that, I mean, these are the main events. We'll get, of course, a monthly breakdown of personal income and spending. No surprise there. We'll continue to see rock bottom savings rates. We get a slew of manufacturing PMI, and I expect the recovering we have seen for the past few months to continue. Jobless claim, we saw the data this morning, rock bottom still. This is noisy data. It's not impacted by the auto workers strike because
Okay.
they are not allowed to claim unemployment in Michigan. And also the union has been very smart and very strategic in targeting the facilities where workers would go on strike. So, I mean, it's likely to show, you know, continued very low numbers. I mean, the bottom line here, if the Fed wants a looser labor market, they need to slow down growth. And I don't think they have the consensus to do that internally. You still have even a hawk like Lori Logan saying that, you know, higher yields are a substitute for higher Fed funds rates. I think that will be proven wrong by the data, but this is going to take another few months. And meanwhile, the economy will run along and will build more imbalances. So, so that's my view on the data for next week. The other thing that's important is, of course, the election for a House Speaker, because that's going to impact whether we have a shutdown when the current continuing resolution expires, which is November 17. So the frontrunner, Representative Jordan, twice failed to get elected. Is probably going to keep you know, going at it. After all, Speaker McCarthy needed 15 rounds to get voted in.
Do you think he has a chance? I thought he's like almost done now.
Well, I'm not sure.
Okay.
There seems to be a fairly high level of dysfunction. I mean, in terms of, you know, whether we have a shutdown or not, I'm going to say probably not, with a low degree of conviction,
Yep.
because
Some
it's,
clients have been asking. Yep.
yeah, because so say 49%, if you want a number of 48 or 45, but basically I'm sitting on the fence because I'm balancing two things. On the one hand, rationality would suggest that the Republicans do nothing that threatens their chances in the election. And traditionally, when Republicans have shut down the government, it's hurt them in the following
Right.
election cycle. So you have that against the sort of uncompromising stance of the extreme right Republicans. So Representative Jordan is one of them, and their, you know, publicly stated culture of not compromising. So I'm assuming that rationality will prevail, but this is a close call.
And could be a silly question.
No questions.
Can they avoid a shutdown by that, even if they have not chosen a speaker? I'm
Yes.
assuming yes. Yeah.
Yes, I suspect that's probably what's going to happen. They will get to November 17. There is a temporary speaker, Representative McHenry. At that stage, they will have no plan, no speaker. The media will pound on them, and they'll probably go for another short-term CR.
Okay. Yeah, that seems like that's kind of what I would guess, that kind of scenario playing out. Yeah, I mean, I didn't understand why the Democrats did this at the time, but I would say so far, if it's purely political standpoint, it looks like a shrewd move because it makes the Republicans complete disarray. And for now, if Jim Jordan does drop out, which I think we're definitely not saying that he absolutely will, that kind of weakens Trump, although he has, a 30-point lead in the poll, so not sure. Okay, the only other thing, I guess, do you want to have a shout out to Sam and Henry? Um, I'm sure you were involved too, that, we have this, for people who don't know, we have this new inflation or CPI prediction model. And I think we've had certainly the last two, one in the US, one in the UK. Maybe we had two in the US, one in the UK. And I think it's perfectly nailed exactly the numbers every time. Not saying that we'll guarantee to do that every time, but for people who haven't checked out those reports, please do. And if you can't see it, these are for our professional investors. Please reach out to one of us and we'll make sure.
Absolutely.
But it's
Sam has
been
done
amazing.
a
Yeah,
fantastic job, and it's a really interesting and innovative approach. So even if you're not trading inflation, you should look up his model because it's a very interesting take on predicting the outcome.
that's true. And for people who are aware, this is something that we're going to continue this approach. We're going to do the same thing for Europe, but our intention is to also look at several other important economic data points, certainly in the most developed markets, and incorporate this exactly as Dominique, you were saying, this model approach that we're doing right now. I guess quick thing where for this past week, if people haven't seen a few kind of really highlight stuff, one, all of Bilal's stuff this week, his kind of UK, I call it morning, but let's say UK morning pieces, um, including on kind of dollar yen, or which I personally agree with, that we're going to see go much higher. The who's buying, the breakdown of who's buying US treasuries and how that's been changing. Obviously, Dominic, your point on the maturity wall, maturity wall, the global rates weekly, so a lot of rate stuff. FX, we've added some bear sterling trades. Also think is a great idea. But a lot more work for people who are focused on FX. That Ben and Rich and the team have been doing a lot of work there. Also, some great stuff in China from kind of Mirza and Liang, and just, I guess, generally in emerging markets, some really interesting, getting great client feedback. If you guys haven't been seeing the pieces and you are focused on EM, the work Mirza and Caroline have been doing has been awesome. And yeah, that's it from me, and good luck, everyone.
Yeah, good luck, everybody. Please keep the feedback going. Negative feedback, especially helpful.
Exactly. Okay, cool. Awesome. Thanks.